Meet Ryan. Ryan is 29. Ryan works in tech. He's not an idiot. He has a degree, he reads, he follows the market, and in 2024, Ryan did what every finance influencer, every CNBC anchor, and every guy at every rooftop bar in San Francisco told him to do. He went all in on AI stocks, Nvidia, Palantir, a couple of smaller names his coworker told him were the next Nvidia. Ryan put in $22,000. By mid-2025, it was $51,000. Ryan felt like a genius. Ryan started talking about it at parties. Ryan's girlfriend started asking if they could retire early. Then, January 2025 happened. A Chinese startup called DeepSeek launched a model that did almost everything ChatGPT could do, built for a fraction of the cost. Nvidia dropped 17% in a single day. Ryan's $51,000 became $38,000 before he finished his morning coffee. Ryan held. Ryan told himself it was just a dip. Ryan is still holding. And here's the thing about Ryan, he might be right. The dip might recover. AI might deliver everything it's promised. Ryan might look back at this moment and laugh about how nervous he was. Or Ryan might be Cisco guy. And if you don't know what that means, you need to watch this entire video before you make another move. Because by the end of this, I'm going to show you something that the AI bulls and the AI bears are both getting wrong. This isn't a simple bubble versus no bubble debate. This is a story about how the most transformative technology in a generation can be completely, genuinely, undeniably real, and still leave a generation of investors absolutely wrecked. Because it's happened before, almost exactly like this, and the guy who called it a permanently high plateau had better credentials than anyone calling AI unstoppable today. Let's start with what the bulls are saying, because they're not entirely wrong. And that's what makes this so dangerous. The mainstream story on AI goes like this. This is the most important technological shift since the internet, maybe since electricity. Companies that don't adopt AI will be left behind. The infrastructure being built right now, the data centers, the chips, the models, will power the global economy for the next 50 years. Nvidia's revenue grew 62% year over year. Microsoft's profits rose 60%. These are real numbers. This isn't dot-com era fantasy companies with no revenue. This is real growth, real earnings, real technology that real people are actually using right now, and if you believe that, you might be completely correct. The technology is real, the growth is real, the disruption is real. But here's the thing, none of that tells you whether the price is right. Which brings us to the numbers. Because the numbers here don't just raise questions, they detonate them. Nvidia's trailing PE ratio sits around 47 times earnings. Palantir, trading at roughly 180 times estimated profits. Snowflake, around 140 times projected earnings. And OpenAI, which is not yet public but sets the entire narrative, just hit a $500 billion valuation. That's up from $157 billion in October 2024. It tripled in 1 year. On $13 billion in revenue. And a commitment to spend $1.4 trillion over the next 8 years building data centers. Let that sink in. $13 billion in revenue. $1.4 trillion in planned spending. That's not a business model. That's a prayer with a really impressive slide deck. And here's where the circular spending problem enters the story, because this is the mechanism that nobody is explaining clearly enough. The biggest AI spenders, Microsoft, Meta, Google, Amazon, are pouring hundreds of billions into AI infrastructure. They're buying Nvidia chips, they're building data centers, they're signing massive deals with each other. And all of this spending shows up as revenue for Nvidia, for the cloud providers, for the infrastructure companies, which means AI company earnings look strong, which justifies the valuations, which keeps the stock prices elevated, which encourages more spending, which creates more revenue. It's a feedback loop that's beautiful right up until it isn't. Because here's the question nobody on the earnings call is answering. Where does the real-world revenue come from? Not the revenue from tech companies paying other tech companies. The revenue from actual businesses, actual consumers, actual productivity gains that justify the $1.6 trillion in total AI spending projected over the next few years. And the answer to that question is not encouraging. A report from MIT's Media Lab in August 2025 found that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. Not low return, not disappointing return. Zero. The National Bureau of Economic Research published a study in February 2026, finding that 90% of firms report no measurable impact of AI on workplace productivity. 90%, zero productivity impact. In the companies that have spent years and billions implementing this technology. And 68% of CEOs say they plan to spend more on AI in 2026, despite the fact that less than half of current AI projects are profitable. They keep spending not because it's working. They keep spending because they are terrified of looking like they fell behind. It's the world's most expensive game of corporate chicken. Are these numbers the whole story? No. AI is early. Productivity gains take time to show up in data. The internet didn't immediately transform productivity either. That took years. Fair point. But that fair point brings us directly to the historical rhyme. The one that should make every person holding an Nvidia position slightly uncomfortable at 2 a.m. The year is 1999. The company is Cisco Systems. If you don't know Cisco, here's the one-sentence version. Cisco made the routers and networking equipment that literally powered the internet. They were not a fake company. They were not a story stock with no revenue. They were the backbone of the most transformative technological shift in modern history. Real technology, real revenue, real growth. The internet was genuinely going to change everything, and it did change everything. The internet bulls were right about the technology. By the year 2000, Cisco had become the most valuable company in the entire world. Its P/E ratio hit 472. 472 times earnings. At its peak, Cisco's market cap touched $555 billion, which at the time represented roughly 4% of U.S. GDP. Analysts were writing about how Cisco would power the global economy for decades. The story was bulletproof, the technology was real, the future was certain. Then the bubble popped. Cisco's stock fell 86% from its peak, 86%. And here's the number that should follow Ryan around like a ghost. Cisco's stock price did not return to its year 2000 peak until 2024. 24 years later. The company survived, the technology survived, the internet survived, and transformed the world exactly like everyone said it would. Cisco kept making revenue. Cisco kept growing. The investors who bought at the peak waited 24 years to break even, if they held, which most didn't. The technology was right, the price was wrong. And those two things destroyed a generation of portfolios. Now, is Nvidia Cisco? Is 2026 the year 2000? Not exactly. Nvidia's P/E of 47 is nowhere near Cisco's 472. Today's tech giants are genuinely profitable in a way dot-com era companies weren't. Back then, only 14% of dot-com companies were profitable. Today's AI leaders are fantastically profitable. The Case-Shiller P/E for the entire U.S. market has exceeded 40 for the first time since the dot-com crash, but that's the whole market, not just AI stocks. But here's what is the same. The top 5 companies now make up 30% of the entire S&P 500, the greatest concentration in half a century. Meta and Microsoft are both projected to have negative free cash flow in 2026 after accounting for all their AI spending. The story being told that these companies are untouchable, that AI will justify any price, that there's only one decision to make when it comes to investing in them, sounds uncomfortably familiar. The Magnificent Seven have become the modern version of the one decision stocks. And we've seen that movie before. It was called the Nifty 50. And then it was called Cisco. And every time, the ending rhymes. So what does this mean for you specifically? Not for the market, for Ryan, for anyone holding AI positions right now. 1. Separate the technology from the price. These are two different questions. Is AI real? Is not the same question as is Nvidia fairly priced at 47 times earnings? You can believe in the technology completely and still believe the price has gotten ahead of the reality. Cisco investors believed in the internet. They were right. They still lost 86%. 2. Understand the circular spending problem. When you see AI revenue numbers, ask yourself, is this revenue from the real economy or is this tech companies paying each other? Real productivity gains that show up in GDP and corporate earnings. Outside the tech sector are what ultimately justify these valuations. Watch for those numbers. They are not here yet. 3. The DeepSeek moment in January 2025 was a warning shot, not a blip. If a Chinese startup can build a model competitive with the best American AI for a fraction of the cost, the infrastructure moat that justifies Nvidia's valuation just got significantly narrower. That is not a small thing. 4. Position sizing is the variable that determines whether this story ends well or badly for you personally. Believing in AI as a technology and betting your entire financial life on the current prices being justified are two completely different decisions. Ryan had $22,000 in. That's a manageable loss if it goes wrong. The people who took out home equity loans to buy Nvidia in 2024 are playing a different game entirely. 5. Watch the free cash flow, not the revenue, not the earnings, the free cash flow. When the biggest companies in the world are projected to go cash flow, negative funding AI build-out, they are betting their balance sheets on a future that has not arrived yet. That is a risk. Price it accordingly. And now here's the uncomfortable truth. The one that applies whether you're a bull or a bear on AI. Nobody knows when this ends. Not the analysts, not the fund managers, not the people running these companies. The technology might deliver $1.6 trillion in economic value and justify every dollar spent. Or the productivity data might stay stubbornly flat, corporate spending might plateau, and the circular revenue machine might slow down, all at the same time. And when that happens to a market carrying this much concentration and this much narrative-driven momentum, small moves can turn into very large problems very quickly. What we do know is this: 95% of companies are currently getting zero return from their AI investments. The companies spending the most on AI are projecting negative free cash flow, and the story being told to justify the prices that these companies are unstoppable, that the technology changes everything, that valuation doesn't matter because the future is infinite, is the same story that was told about Cisco in 1999. Cisco did change everything. The internet did change everything. And the investors who bought at the peak still waited 24 years. So I want to know where you land. Do you think AI is different enough from the dot-com era that the Cisco comparison doesn't apply? Real profits, real growth, real moats that justify current prices? Do you think this is a textbook bubble and the 95% zero return statistic is the canary in the coal mine that everyone is ignoring? Or do you think the truth is somewhere in between? The technology is real, the bubble is also real, and the question is just whether you can time the exit before it matters? Drop it in the comments. Because after going through this data, the number I can't shake isn't the PE ratio. It's not the $1.4 trillion OpenAI spending commitment. It's the 20 years. The 20 years Cisco investors waited to break even on a technology that genuinely, actually, undeniably changed the world. Ryan is still holding. The technology is still real. And somewhere in Silicon Valley, someone just called AI a permanently high plateau.